Something shifted in the silver market today, but not in the way most people think. Prices moved higher again after falling just days earlier, and that alone should make you pause. Because when a market rises, falls, and rises again within the same week, it usually means one thing: uncertainty is rising and positioning is changing. Right now, silver is trading near $77 to $80 per ounce globally, after gaining nearly 1.9% in the latest session. But here's what matters more. This move didn't happen in isolation. It came at the exact same time. U.S. Treasury yields started easing slightly, oil prices remained volatile, and geopolitical tension in the Middle East stayed unresolved. Pay attention. Don't ignore this. Because what you're seeing right now is not just a price movement. It's a reaction to a much larger global shift. Let's break this down carefully. Silver is what economists call a non-yielding asset. That means it does not generate income like bonds. So when central banks, especially the U.S. Federal Reserve, keep interest rates elevated, investors often move money away from silver and into assets that generate yield. This is not speculation. This is a fundamental concept of monetary policy transmission. And right now, markets still expect interest rates to remain relatively high, even with uncertainty rising. That creates pressure. But here's where it becomes more complex. At the same time, inflation is starting to move again. In fact, recent data shows UK inflation rising to 3.3%, driven largely by energy prices linked to the Iran conflict. And the International Monetary Fund, IMF, has already warned that global growth may slow, while inflation could rise modestly in 2026 due to geopolitical and energy disruptions. Think about that. Inflation rising, growth slowing, rates staying high. That combination is what economists often describe as a stagflation risk scenario. And historically, that kind of environment creates instability across markets. Now here's the contradiction. Silver is traditionally seen as a hedge against inflation. So if inflation is rising, silver should be moving higher. But it's not breaking out. Instead, it's moving sideways, volatile, uncertain. And that's your first real signal. Because when fundamentals and price behavior don't match, it usually means something else is influencing the market. Now let's go deeper. Right now, silver is being influenced by three macro forces at the same time. First, interest rates, still elevated, still restrictive, still limiting upside. Second, the US dollar, which has remained relatively strong during periods of geopolitical stress. And third, energy-driven inflation. Oil prices have surged above key levels recently as tensions in the Strait of Hormuz disrupted supply expectations. And here's why that matters. Energy costs feed directly into inflation. And when inflation rises, central banks are less likely to cut rates. Which brings us back to pressure on silver. Now pause for a moment. Ask yourself this. If inflation is rising and demand is still strong, why is silver not breaking higher? That's your first curiosity hook, because the answer is not simple. It comes down to something most investors overlook. Liquidity. Liquidity is the amount of money flowing through the financial system. When liquidity is high, markets tend to rise. When liquidity is tight, markets struggle to move. And right now, global liquidity conditions remain relatively constrained. Central banks are still cautious, still watching inflation, still balancing growth risks. Even the IMF has highlighted that uncertainty and energy shocks are tightening global financial conditions. And that matters, because even if silver has strong fundamentals, without liquidity, it cannot move freely. Now let's connect everything. Right now, silver is being pulled in two directions. On one side, you have macro pressure, high interest rates, strong dollar, tight liquidity. On the other side, you have structural support, ongoing supply deficits, industrial demand, investor interest. In fact, The silver market is expected to remain in supply deficit for the 6th consecutive year. That's not a small detail. That's a long-term imbalance. And historically, when supply remains tight, prices eventually adjust, but not always immediately, because in the short term, macro forces dominate. And that's exactly what we are seeing right now. A market caught between fundamentals and policy, between demand and liquidity, between fear and positioning. Now here's where things become even more interesting. Over the past few weeks, silver has shown extreme volatility. It dropped sharply, then surged again, then pulled back once more. At one point, the market saw a near 50% correction from its January highs. That kind of movement is not normal. That kind of movement usually indicates repositioning by large participants, institutions, funds, global capital. Because markets don't move like this without a reason. And here's the key idea you need to understand. Markets don't wait for certainty. They move based on expectations. So when you see volatility like this, it often means one thing: the market is preparing for something before it becomes obvious. And right now, that preparation is happening quietly, behind the scenes, before the next move, before the next catalyst, before Monday. Stay with me. Don't miss this. Because in the next part, we're going deeper into what central banks may be watching right now, why institutional money is not exiting, just waiting, and what scenario could trigger the next major move in silver. And once you see that, you'll understand why this moment may be more important than it looks. You're still looking at the price, but the real story is not the price. It's what the system is doing behind the price. Because right now, central banks are watching something very closely, not silver directly, but the forces that control it: interest rates, inflation, liquidity. And if you understand how these three interact, you start to see why silver is behaving this way. Let's go step by step. Right now, global markets are in a very unusual position. On one side, inflation risk has not disappeared. In fact, energy-driven inflation is rising again. Oil prices have moved close to $100 per barrel as tensions around the Strait of Hormuz continue. And historically, energy shocks like this don't stay contained. They spread. They move into transportation, into production costs, into consumer prices. And that creates inflation pressure. Now, normally, when inflation rises, central banks respond. They tighten policy. They keep rates higher. And that's exactly what we are seeing. Across multiple economies, central banks are either holding rates high or preparing for further tightening. Even expectations around the U.S. Federal Reserve are shifting. Markets are no longer confident that rate cuts will come quickly. In fact, some forecasts suggest cuts could be delayed further, depending on inflation data. Now pause here, because this is critical. When interest rates stay high, liquidity stays tight. And when liquidity stays tight, assets like silver struggle to trend upward, even if demand is strong, even if supply is limited. And this is where most people get trapped. They look at silver as just a commodity, but it's not. It's also a liquidity-sensitive asset, which means it reacts to money flow, not just fundamentals. Now here's where it gets even more interesting, because while macro pressure is building, something else is happening quietly. Demand is not collapsing. In fact, investment demand for silver remains stable, even in this uncertain environment. According to the Silver Institute, global silver demand is being supported by rising physical investment, even as industrial demand fluctuates. And at the same time, the market is facing a structural issue. Supply is not keeping up. The silver market is now expected to face its 6th consecutive year of supply deficit. Think about that. 6 years where demand has exceeded supply. That's not a short-term imbalance. That's a structural shift. And historically, markets cannot ignore that forever. But here's the catch. Even with that imbalance, Prices are not moving in a straight line. They are volatile. Sharp up moves, sharp down moves. That's not weakness, that's compression. Now, let me show you something important. Silver recently dropped more than 30% from its 2026 highs, even after gaining over 130% year over year. That kind of movement is not random. It suggests repositioning, because when large institutions adjust exposure, they don't move slowly. They create volatility. And that's exactly what you're seeing right now. Pay attention. This is where it matters, because institutions don't react to headlines the way retail investors do. They react to expectations. And right now, expectations are shifting. Not dramatically, but subtly. Markets are starting to question, will inflation stay higher for longer? Will central banks delay easing? Will geopolitical risks continue to disrupt energy markets? And if the answer to even one of those questions is yes, the entire macro environment changes. Now let's bring this back to silver, because this is where everything connects. Silver sits at the intersection of monetary policy, industrial demand, investment behavior. And right now, all three are unstable. That's why price action looks chaotic, because the market is trying to price in multiple possible futures at the same time. And that creates something very specific, volatility. In fact, analysts are already warning that precious metals are likely to remain volatile in the near term due to geopolitical uncertainty and macro shifts. Now here's the part most people don't realize. Volatility is not the problem. Volatility is the signal. Because before major moves, markets don't move smoothly. They shake, they test levels, they force weak positions out, and then they move. Now let me ask you something. What happens when a market has tight supply, stable demand, high macro pressure, and rising uncertainty? That's your first curiosity hook, because historically, that combination doesn't lead to stability. It leads to a breakout, but not immediately. First, it builds pressure, and that's exactly what we're seeing right now. Silver is not breaking down, it's holding. Despite pressure from high interest rates, strong dollar conditions, tight liquidity, and that alone should tell you something, because weak markets don't hold under pressure, they collapse. But this one is absorbing it, and that's a very different signal. Now let's go one step deeper, because something else is happening, and almost nobody is talking about it. Liquidity conditions are not static, they change, slowly, then suddenly. And when liquidity shifts, precious metals often react quickly, because they are sensitive to changes in monetary policy expectations. And right now, markets are watching every signal from central banks, every inflation print, every rate decision, every policy hint. Because even a small shift could change the entire direction of this market. Now think about timing. We're heading into another trading week. Markets are already unstable. Positioning is already shifting, and volatility is already elevated. Which raises one critical question. What happens when markets reopen after this kind of setup? That's your second curiosity hook. Because historically, when markets enter a new week under these conditions, moves can accelerate, not slowly, but suddenly. And if you're not prepared, you don't react in time, you react after. And by then, the move is already underway. Stay with me, don't miss this moment. Because in the next part, we go even deeper. I'm going to show you what scenario could trigger the next major move, why silver may react faster than expected, and what signals to watch before the breakout or breakdown. And once you see that, you'll understand why this moment may not last much longer. Right now, the market is not waiting anymore. It's positioning quietly, carefully, but aggressively, because something is getting closer. Not confirmed yet, not obvious yet, but visible, if you know where to look. And here's the first signal. Silver is no longer reacting normally to news. Just days ago, silver dropped sharply, over 4% in a single session. Then, within days, it jumped again. And at the same time, in India, silver surged nearly 5,000 rupees in a single move after geopolitical updates around Iran. That kind of behavior is not random. That's instability. And instability usually comes before expansion. Now listen carefully, because this is where the real story begins. Right now, 3 potential triggers are forming. Not 1, not 2, 3. And any one of them could move this market fast. Let's start with the first one. Trigger 1, interest rate shift. Everything right now comes back to interest rates because silver does not move alone. It moves with liquidity, and liquidity is controlled by central banks, especially the US Federal Reserve. Now here's what's happening. Markets expected rate cuts earlier, but that expectation is no longer stable because inflation is not fully under control. According to the International Monetary Fund, IMF, global inflation is expected to rise modestly again in 2026 before stabilizing later. That changes everything, because if inflation stays higher, central banks may delay easing. And if that happens, liquidity stays tight. And if liquidity stays tight, silver stays suppressed. But here's the flip side. If inflation stabilizes faster than expected, or growth slows sharply, central banks may pivot. And when that happens, liquidity increases. And historically, precious metals don't wait. They react fast. That's trigger number 1. Now let's go deeper. Trigger 2, supply shock. This is something most people are ignoring, but it's already happening. Right now, the global silver market is facing a massive structural deficit. For 2026, that deficit is expected to reach over 46 million ounces. And this is not new. This is the 6th consecutive year where demand is exceeding supply. Think about that. 6 years of imbalance. And how is the market handling it? By drawing down inventories, by releasing stored metal, by absorbing pressure. But here's the problem. That strategy doesn't last forever. Eventually, inventory runs low. And when that happens, prices don't adjust slowly. They adjust aggressively. Now add one more layer to this. Just days ago, reports showed that India, one of the largest silver importers, has paused imports due to regulatory delays. That might sound minor, but it's not, because supply disruptions, even temporary ones, can tighten the physical market further. And in a deficit environment, even small disruptions matter. That's trigger number 2. Now here's where things get serious. Trigger 3, geopolitical shock. Everything right now is connected to energy, and energy is connected to inflation. And inflation is connected to central bank decisions, which brings us back to the Iran situation. Markets have been reacting to ceasefire extensions, peace talks, threats of escalation, and each headline moves the market. Oil spikes, inflation expectations rise, and silver reacts. Then peace headlines come, oil drops, and silver moves again. This back and forth is creating instability. But here's the key insight. Markets are not reacting to what is happening. They're reacting to what could happen. And that creates something dangerous. Volatility compression. Because when markets price in multiple outcomes, they become unstable. And when instability builds, moves don't happen gradually. They happen suddenly. Now let me ask you something. What happens when supply is tight, demand is stable, liquidity is uncertain, and geopolitics is unstable? That's your first curiosity hook, because historically, that combination does not stay quiet for long. It builds, and then it breaks. Now here's something even more important. Silver is not weak right now, it's holding, despite a strong dollar, high interest rates, tight liquidity, and that matters, because weak markets collapse under pressure, but strong markets absorb it. And that's exactly what silver is doing, holding near $77 to $80 levels despite extreme volatility. That's not weakness, that's positioning. Now think about timing. We are heading into another trading cycle. Markets are already unstable. Positioning is already shifting, and volatility is already elevated, which leads to one critical question. What happens when markets reopen? After this setup, that's your second curiosity hook. Because historically, when markets enter a new week under pressure, moves don't stay small. They expand, and they expand fast. Now let's bring everything together. Right now, silver is sitting in a compression zone, held between macro pressure, structural demand, and geopolitical uncertainty. And that's the exact environment where breakouts are born. Not guaranteed, but possible. And if it happens, it may not give warning. It may happen suddenly, before most people react, before most people understand. Stay with me. Don't ignore this. Because in the final part, we go into the most important section. I'm going to show you the exact breakout versus breakdown scenarios, what signals to watch before the move, and why this moment could define the next phase of the silver market. And once you see that, you'll understand why this is not just another market move. It's a setup. And setups don't last forever. Right now, the market is not calm. It only looks calm because underneath, pressure is building. And you can already see it if you connect the signals. Silver is still holding near $77 to $80 globally, even after extreme swings in the last few days. In India, prices are still elevated around 2.6 to 2.7 lakh rupees per kilogram after sharp spikes and drops within the same week. This is not stability, this is tension, and tension in financial markets doesn't last forever, it resolves. Now the question is not if something happens. The question is, in which direction? Let's walk through this carefully, because this is where most people make mistakes. They expect markets to move slowly, but historically, that's not how it works. When conditions align, markets can move very fast, and right now, conditions are aligning. Look at the setup. Interest rates are still high. Central banks remain cautious. Liquidity is still tight. At the same time, geopolitical risk is not resolved. Even with ceasefire extensions, tensions in the Middle East remain unstable, and that matters because energy markets are directly linked to inflation. When oil moves, inflation expectations move, and when inflation expectations move, central bank decisions change. And when central bank decisions change, liquidity changes. And when liquidity changes, silver reacts. This is the chain. And right now, that chain is unstable. Now pause here. Ask yourself this. If even one of these factors shifts, what happens to the entire system? Because that's exactly what markets are trying to price in. Multiple outcomes at the same time. And that creates something very specific. Compression. Now let me show you the two scenarios, because this is where everything becomes clear. If interest rates stay higher for longer and inflation continues rising, central banks may delay easing further. Liquidity stays tight. And in that environment, silver could face pressure again. We've already seen how fast that can happen. Just days ago, silver dropped sharply in a single session before bouncing back again. That tells you something. The downside risk is still present, not guaranteed, but possible. Now let's look at the other side. If inflation stabilizes or economic growth slows, central banks may shift their stance, even a small shift, even a signal. And when that happens, liquidity could increase. And historically, this is where precious metals respond, not gradually, but quickly, because markets don't wait for confirmation. They move on expectations. And right now, expectations are fragile. That's the key word, fragile. Now let's connect this to what we're seeing. Silver has already risen more than 130% year over year, but is still down significantly from its 2026 highs. That means something important. The market has already moved once, but it is not fully resolved. It's still deciding, still adjusting, still preparing. And that's exactly where we are right now, in the middle, between two outcomes. Now here's the part you need to understand. Markets don't stay in the middle for long. They choose a direction. And when they do, they move. Now think about timing. We are heading into another trading cycle after volatility, repositioning, conflicting signals. And historically, this is when moves accelerate. Not always, but often. Now let me ask you one final question. What happens when markets reopen after a week like this? Because that's where we are right now, this weekend, before Monday. And if something shifts, even slightly, the reaction may not be slow, may be immediate, and that's why this moment matters. Not because something has already happened, but because something could. Now listen carefully. This is not a prediction. This is not a guarantee. This is a setup built on macro pressure, structural demand, and geopolitical uncertainty. And historically, those setups don't stay quiet forever. They resolve, sometimes gradually, sometimes suddenly. Pay attention. Don't miss this moment, because by the time the move becomes obvious, it's already underway. And most people are reacting late, watching headlines, instead of watching signals. Now here's what you should do. Stay aware, stay informed, stay patient. Because in markets like this, timing matters. And right now, timing is everything. If you want real breakdowns like this, subscribe to the channel, like the video, and comment what you think happens next. Breakout or breakdown. Because the next move may not give a second chance. And once it starts, you'll understand why this moment was more important than it looked.